Hey guys, welcome to the second video in the beginner's guide to Forex. Today we're going to be looking at identifying trends and why you should always trade with the trend. I've always been told the saying, the trend is your friend, and I guarantee you that if you look back at your past trades, that the majority of your losses will be going against the main trend on the higher time frames. Because as you can see by looking at the charts, Forex pairs tend to trend, if you look here, it's going up and it's going to continue going up, but if you look more on the higher time frame or just zooming out on the lower time frame, you can see trend is going down. Even these pullbacks, it likes to go up and down, but in one direction, and it's been doing this for a long time. You don't get many times where the trend is going down and it's just going to shoot back up and start different trend reversals. Are a lot rarer than trend continuations. Obviously on the lower time frames you do get a lot of things that could be reversals, but it's just internal structure. So the way to increase your odds of entering a winning trade is always best to just trade with the trend. To be able to do this, you first need to be able to identify the trend. And so I'll be showing you a few different ways to do this, and the different methods will suit different skill levels of traders. For beginners who are still learning how the markets work, I suggest using moving averages, which is an indicator. So the moving average basically smooths out price by taking an average of price over the last X amount of candles, depending on what period you set it to. So for example, if you go to indicators up here and then type in EMA, you get a moving average exponential. Click on that and then come up here and just click on the settings, length. You can change it to 200 and there. So the last 200 candles all average out to give a price of 1.19504. So this is the main moving average that I'll introduce you to. It's very good at capturing the longer term trend, as you can see. When price is below the 200 EMA, you can see we're in a downtrend. And then when price is above, you could say we're in an uptrend, or it could just be a pullback before we continue this lower trend. But when price is trading around, up and down, crossing it, you're in consolidation, and this is just a trading range. You don't want to be trading in this unless you're very experienced, but I'd recommend staying away from times like that because there's lots of opportunities when you're in proper trends. A way to use this to filter your trades is to only take short positions when you're below the 200 EMA and only take long positions when you're above. It will filter out some winning trades, so you will miss out on a few winning trades, but it will also mainly filter out your losing ones. And so overall it is definitely useful. What you can do as well is add multiple just to get a stronger sense of the trend. So you can add the 50, I'll put it in a different color, say orange. And then you can see when they're both aligned with the orange 50 below the 200 or the orange below the blue, you're definitely in the downtrend. And it basically stops you from getting caught out like here when price is above the 200 EMA, but the 50 is still below the 200. It could be the start of just a trading range, which you can tell when you are in the trading range, they're very close together and they're just not much is happening. So it's just another way to filter out those losing trades. If you are a more advanced trader, however, I'd recommend not using these and looking at market structure instead. So I'll go more in depth about market structure in another video, but I'll just cover the basics here. So to be in an uptrend, you want price to create higher highs and higher lows, looking something like this. Which label HH stands for higher high and HL stands for high low. So when you've got a series of high highs and higher lows, you're in an uptrend and you'll be looking for buys. And opposite is true for a downtrend, you're looking for lower highs and lower lows. And the main method with this kind of way of trading is you want to be trying to buy at these higher lows, targeting wherever, but it's just obviously you won't be able to target the exact higher high, but you can get a lot better risk reward compared to if you were, say, buying on a breakout with the same stop loss, the same target. Obviously, there will be some internal structure, so obviously not going to be up and down like this. It could be like more like something like that maybe. Price isn't just going to make these perfect zigzags, but you just have to train your eye to mainly notice the major swings, and that's something that I'll cover more in depth in a future video. One thing to also note is that the higher time frame you're on, the stronger that trend will be. For example, if you notice high highs and high lows on the 4-hour time frame, if I just go, so you can see these lower lows and lower highs being formed on the 4-hour time frame, then that shows you're in a strong downtrend. Whereas if you went on to say 5-minute and you were looking here, you see high highs and high lows, you might think you're in an uptrend and you might try and buy and then get taken out because the true trend is actually bearish. So that's just something to look out for. That's going to be it for this video. So as always, if you have any questions, just leave a comment and I'll try and help you out. Thanks for watching, and leave a like and subscribe if you like the content.